Hello, everybody. Welcome to Collab Investments. Today, let's talk about company stocks, RSU and ESPP. If you work in a tech company, very likely your company will offer you these two programs. For ESPP, it is Employee Stock Purchase Plan, where you're allowed to buy stocks at a 15% discount, and you buy it at a lower price at the beginning and the end of a usually 6-year period. And another one is called RSU, Restricted Stock Unit. So for many people, RSU might be a major source of your income. It can be much higher than your salary. And for many people working in the tech industry, it very likely become your first pot of gold, where it's a basis that you can build up your asset and eventually you can retire from it. But RSU and ESPP, they are concentrated on the single stock that you're working for, in the company you're working for. So it is usually a lot more risky than stock index I talked about before. So it's higher risk and high reward. If you work in a company that has a very good stock like NVIDIA, you would be very, very happy, but also the risk is also higher because look at Meta, the stock goes high and goes low. Its swing is very big. So it comes with big risk. And in addition to that risk, you usually also have lots of unvested stocks. And that makes your risk even bigger because you are not allowed to sell your unvested stock. So my solution to this is I would like to sell to reduce my risk because I already have other unvested stock and those I cannot sell. So once I have new stock vested, I would sell it immediately. And one advantage of selling it at that time is it doesn't have capital gain tax because after it vests, its cost basis is already the price of the stock price and the vesting day. So if I sell it on that day or on the next day, very likely there's no capital gain tax. And after I sell it, I would buy stock index with the proceeds so that I converted my single stock into a stock index, which I can hold for a very long time. I almost never sell afterwards. Okay, so now let's look at if you have some old RSU shares that you didn't sell at the vest time, what should you do with it? So let's say you have 200 shares, they vested at different times. You have 100 shares, and the vest price is $80, and another $100 was vested at $70. But today, the stock price is $75. So my question is, if there is no tax, so let's simplify the assumption first. If there's no tax and you want the money, you need to sell 100 shares. Which lot would you sell? You can pause the video, think about it, and then you can resume. Okay, now my answer to this is it doesn't matter. You sell 100 shares, you get 75 times 100, that's the amount of dollar you get. No matter what cost basis you have, if there's no tax, then it doesn't matter. And there's one effect, people call it anchoring effect, that everybody need to overcome, or many people needs to overcome. So you may feel that selling the second lot, where you bought at $70, you have a $5 gain. it may feel comfortable when you sell $80 where you are taking a loss. But it doesn't matter. You already have the share and it's sink cost. So only the current price matters. You need to forget about the price you bought. But this question is too simplified because in reality, there is tax. So if there is capital gain tax or capital loss, so which one would you sell? Again, this is a more important question because it has tax. Okay, my answer is you need to sell the shares with high cost basis. So basically sell the first lot where you bought at a higher dollar price. So if you sell at a high cost basis, you pay less tax. You have, in this case, you have capital loss where you don't pay tax. It can even offset your other capital gain. Or if the stock price is higher than both, you still pay less tax upfront, which I think is a good thing. Or if you don't have any other capital gain and capital loss, in this case, you can sell some with high cost basis and some with low cost basis so that the capital gain and the capital loss can offset with each other. And in this case, you don't care whether they are long-term capital gain or short-term capital gain, long-term or short capital loss, because they can all cancel out with each other. The only case you want to avoid is do not have lots of short-term capital gain in that tax year, because that gives you the highest tax that you need to pay. Okay, so this is about RSU. Now let's look at ESPP. So with ESPP, the simple rule is I would wait for 2 years to get the qualifying disposition. 2 years starting from the where your money is getting deducted from your salary. And if it's a qualifying disposition by waiting for 2 years, most of the gain in the stock is counted as long-term capital gain. Otherwise, many of them will be counted as regular income, where you often pay a lot more tax. So for example, if at the beginning of 2021, you start deducting your wages toward buying the ESPP after 6 months. And then after 6 months, you buy the stock with 15% of the discount of the lower price in these 2 dates. And after that, after 2 years, the beginning of 2023, now you can finally sell as a qualifying disposition. So if you look at the timeline picture below, in order to get a qualifying disposition, you need at least 1 year after the purchase date. And between the offering period and purchasing date, most companies use 6 months. But between the beginning period and the sale date, you're required to wait for 2 years. So these 2 years is the time you need to watch. Okay, that's all for today. Thank you.